Hello and welcome to the Investing on the Go podcast. I'm James Yardley and I'm joined today by Nick Martin, the elite rated manager of the Polar Capital Global Insurance Fund. Nick, thanks for joining us today.
It's an absolute pleasure, James. Thanks a lot for having me.
Nick, some people think of insurance as a safe haven, but this obviously wasn't the case during the global pandemic. So what was the initial reaction when it hit?
Yeah, so if you do think about insurance, and when we're talking about insurance, it's important to remember we're talking about non-life insurance or property casualty rather than life insurance. You know, it's not a discretionary purchase. It's something that's often required by law. And you can think about in a personal capacity, you know, car insurance, is required. You know, your mortgage lender requires you to have home insurance, and exactly the same for businesses as well. So the demand for insurance tends to be robust, almost despite the macroeconomic conditions you're kind of faced in. And if you overlay that as well with the fact that, you know, insurers are taking on the risk that you and I do not want, so they don't double up that risk with exciting things in their investment portfolios, it means that their investment leverage is low, their investment risk is low, and therefore overall there's a rather disconnected return from non-life insurance compared to the broader financial markets. And in most cases, that means it's a relative safe haven in sort of choppier waters. But that wasn't the case last year with the onset of COVID. And I think a lot of that is the industry is very used to dealing with natural catastrophes, whether that's hurricanes or earthquakes. But those things are really defined by sort of time and geography. So if a hurricane happens, you can get an idea pretty quickly of the extent of the damage that's occurred, whereas a pandemic is actually something very different because, as we've all sadly seen, it can last for a long period of time and can travel across borders. And that introduced an element of uncertainty to the industry that we haven't seen fortunately to a great extent before. But I think it's important to remember, because pandemics are not constrained by time or geography, it does mean that the underwriting of that pandemic risk is very challenging because, in an extreme, an underwriter is taking on, some uncapped exposure. And that's why a lot of policy wordings for many, many years excluded pandemics and communicable diseases. But obviously in the sort of panic that the financial markets had, a lot of that got kind of lost in the commentary. And ultimately, we said back in April of 2020, this would be an earnings event for the industry, sort of taking a normal catastrophe year and making it a rather larger than normal one. And that's sort of proved to be the case. And
in January, you said the underwriting market was looking the strongest you'd seen it for a very long while. Is that still the case? And why is it so strong at the moment?
Yeah, absolutely. It's still the case. And, I've been invested in the insurance sector now for almost 20 years, and I haven't seen as strong as underwriting markets as these that we currently have since I started out back in 2000. And one, and usually when you have a sort of hard pricing environment, so in other words, premium rates are going up. Now it's usually as a result of an industry, a balance sheet stress. That's often as a result of a major catastrophe or maybe something's going on in the financial markets. But this time, and I'm always worried when I say a variation of these words. It is a little bit different because there is a number of factors that have caused this underwriting market. We've had a prolonged low interest rate environment now for many, many years. As I just said, these companies have very conservative investment portfolios because you need liquidity in your balance sheets because claims can happen at any time. So we're talking about lots of cash, sort of 2-year bonds, and sort of investment returns on those kind of assets have largely evaporated since the financial crisis. So you have to make an underwriting profit, because if you don't, you're not going to make a satisfactory return for your stakeholders. So that's led to a lot greater discipline coming into the industry. Pricing has had to go up for this, and we're talking about an industry where, in the aggregate, the returns aren't that great. So so a lot of the more marginal average players have had to take disproportionate action on the underwriting side to get the returns to where they needed to be, and therefore that is actually a very good environment for the best-in-class operators in that. And we have seen the return of Mother Nature. 2013 to 16 was a relatively benign period, but she came back with a bit of a vengeance in 2017 with a record catastrophe year. and it's been pretty tough ever since. And that's sort of led to rising reinsurance costs, which are of course an input for you as an insurance company. So again, that led to more pricing coming through. And then finally, of course, we've had COVID, and I think that's just generally led to a reappraisal of the price of risk, and has actually curtailed the risk appetites of quite a few people within the industry, and actually the larger companies more so than anything. And again, that's really given some opportunities for the smaller companies where I tend to focus. Within the my insurance strategy, where we try and keep that sort of natural catastrophe exposure to quite a low amount, and therefore we're very hopeful that our companies are set for some good book value growth over the coming sort of 3, 4, 5 year period.
You recently talked about how the insurance industry is playing a role in tackling climate change. It's not something which sort of immediately springs to mind. So what did you mean? Yeah.
So I think, insurance companies just generally just take on the risk that you and I, don't want. They absorb that volatility that we as individuals or companies can't handle. And obviously climate change is a huge source of volatility, and has been, and that's sadly that's increasing over time. So the industry has got a very critical role in helping to manage that associated volatility, and also promote behaviours that help address the climate crisis and also the biodiversity crisis that we've had. And I think when I started out in this business 20 odd years ago or so, the sort of talk when in a natural catastrophe context was really around hurricanes and earthquakes. But in recent years, we've seen the emergence of sort of secondary perils, things like flood, drought, and especially wildfire. And it's indisputable that those are closely linked to climate change, and then that needs to be sort of dealt with. And we've seen some sort of encouraging developments over time, and even preceding sort of everything that's happening with ESG. We're kind of broadening the scope from just climate and into the critical importance of increasing biodiversity as well. And with those kind of disclosures coming in, we all know what gets measured gets sort of done, and therefore those increased disclosures are going to give stakeholders they're going to think about their companies and how they're managing the risk that they're talking about. And insurance is a very big part of how you manage that risk. So it should be a very strong tailwind to the sector for many years to come. And
is climate change and the pandemics and all the increasing risk we see, is that increasing the demand for insurance globally? And
I think it certainly is increasing the demand for insurance, but you do start to get a bit of a challenge in all of that, because if you have an increased propensity of loss, the insurance companies naturally are going to need more premium to underwrite that particular risk. And at some point in time, that you could have a situation where insurance becomes unaffordable in the more riskier parts of the world. So maybe think of something like California, that historically has been very exposed to earthquake risk. You can now overlay wildfire risk, sadly, on top of that. And if you have a property there, that says maybe it's worth $1 million rebuild cost, and if your risk of that getting burnt down once every 10 years, your insurance company should charge you a premium of something north of $100,000 a year, and who's going to maybe pay that? And so therefore you move into an area where some things become uninsurable, risks get too great, and therefore that's why I think we're going to see more and more sort of partnerships between the private insurance industry and governments more generally into dealing with some of those big risks. And you can put pandemic within that as well, because the insurance industry balance sheet can only take so much of a loss, and therefore you do need government backstops beyond this. And we've got precedent for that. We've had that with terrorism risks. Post World Trade Center, we have that with flood risk to some extent. In some countries as well. So we do sort of see that sort of coming in, but we are seeing the emergence of what's been called nature-based solutions. So this is where nature is being a risk prevention partner for the insurance industry to some extent. And nature-based solutions are all about letting nature restore biodiversity. Is a bit more beyond sort of traditional conservation, which tend to be, think of small nature reserves that are heavily managed in order to optimize for a particular species. We're talking about more broader ecosystems within this, and they tend to improve wildlife, improve soil health, and maybe it's best illustrated by example. So many of the industry nature-based solutions are focused around coral reef and mangrove restorations, because it is much better to have coral reefs and mangroves to be a sort of a buffer for storm surge post a hurricane than it is to build huge cement walls, for example. And we've got for example, Chubb's doing an interesting project in Miami, partnering with the Nature Conservancy. And Florida hurricane risk is still the biggest catastrophe peril in the world when it comes to insurance. There's something like $3 trillion in insured values kind of there. And what mangroves essentially do, is prevent coastal erosion by decreasing the height of waves and therefore reducing that onshore property damage. And of course, mangroves and things like seagrass as well, they're very good carbon sinks and therefore can store a lot of carbon dioxide. So it's a win-win for all concerned. So that's something I expect to see a lot more of in the future.
And in regards to inflation, there's been a lot of talk about inflation recently potentially coming back. Is the insurance sector a net beneficiary of this, or is it hurt?
Yeah, it certainly is a net beneficiary, I'd say, James. And you need to, almost speak again, the non-life insurance sector can be a little bit different from other parts of the financial market. And, sometimes when you do hear a sort of, rise in inflation, that does sometimes, ring alarm bells for understandable reasons. But I think, in insurance, inflation is kind of always there, and something like CPI is not necessarily the best measure of inflation in an insurance context. And things like medical cost inflation is probably a bigger driver. And as we've seen for many years, that's only gone one way for a very long period of time. And I think a key attraction that we have as a sector is that the insurance contracts get repriced annually. So as long as inflation, behaves itself in terms of its expectations, the insurance companies can price for that and therefore maintain satisfactory underwriting margins. And where it can kind of go wrong is if you have sort of the rampant unanticipated inflation, and especially in the context if you underwrite what's called sort of long tail business. So this is where you're assuming risk today. And your likely loss payments, if they happen, sort of many years in the future. So think about something like pharmaceutical liability, where that you won't know whether there's a problem with a drug or something like that, maybe for 15 to 20 years or so. And therefore, if you've got your pricing and your inflation expectations wrong in the pricing of that product today, you've got 15 or 20 years of compounded error that comes through into that, and you can have yourself a big problem down the line. So that's something we try and avoid within the strategy, and fortunately for us, we tend to focus more on sort of the small to mid-sized specialty underwriters, and a lot of that long tail casualty risk tends to sit in those big large conglomerates that have been around for many years, and that gives sort of the reassurance to the board of directors of that pharmaceutical company as an example when they're taking on that risk, because they need to be sure that those insurance companies are around in 15 to 20 years to pay those potential claims. You
sound very positive on the sector, but it's struggled for the past 2 years or so, relatively at least, to global equities. So why has the market not reacted more? And is this an opportunity for investors?
Yeah, I think it is. We've talked a lot about we've had a strong underwriting environment. Underwriting margins are in a good place. We expect them to further improve given what's happened with the pricing environment in the last couple of years. We could also have the tailwind of increased investment income if bond yields go up because of rising inflation expectations. And so in that sort of scenario, the earnings power of our companies is rising, and you would expect that to be rewarded with a higher multiple, particularly with a backdrop of broadly rising markets. And there's a number of sectors, if not many sectors of markets, that are trading near historical highs in terms of valuations. That's certainly not the case in insurance. We're trading marginally above the 30-year average if you look at the US industry price to book valuations. And at the end of the day, long-term returns are highly correlated with growth in book value per share. And I think at the moment, a well-run insurer, can do, certainly 10%. I was being concerned on that metric, and I think in this environment a little bit more than that. So if if a share price just follows that book value growth trajectory, all else equal, you double your money in 7 years. And so, but I think the thing about the industry we've always had, is it a get rich slow kind of industry? It's this slow compounding of returns. Don't make mistakes, don't lose capital. Push your foot to the floor a little bit when market conditions are there, like the times like now, for example. But we do sadly live in a financial market which can be a little bit myopic. It can be a bit of an obsession about next quarter's as earnings, and I think a lot of investors just don't have the patience to sort of really be there for compounding to work its magic, and therefore valuations in insurance tend to stay in a relatively narrow range. And I think for me, and as an investor in the sector, that suits me fine, because over time our performance will closely match the fundamental performance of our companies, and we were not beholden to mood swings of Mr. Market. And I think right now Mr. Market is a little bit too gloomy, and given what I've said, this being the best underwriting market I've seen since 2001 or so.
Great. Well, thank you very much for joining us today, Nick.
Absolute pleasure. Thanks for having me.
And if you'd like to learn more about the Polar Capital Global Insurance Fund, please visit FundCalibre.com. And please also remember to subscribe to the Investing on the Go podcast. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at your time of listening.